Markets are taking a hit. All markets, not just the gold markets, equities too, as yields continue to rise. The 10-year is now above 1.5%. The dollar is up as a result, and Peter Hugg, Global Trading Director of Kitco Metals, is here to discuss this today. Peter, welcome back. Volatile markets this week, much more than last week. How are you reading it?
Well, I mean, when we spoke last Friday, I indicated that I thought gold had a good shot at getting over 1800, where I saw little resistance and possibly test 1820. It sure looked good on Monday. It got up to 1817. But then that 10-year bond yield continues to rise, putting pressure on both the equity markets and the commodity markets. It's taken the edge off a dollar that was headed lower at the beginning of the week. And with the stock market selling off both Wednesday, yesterday, and down some 400 points now, 300 points right now as we speak, there's just been a move to cash, and there's been a selling of risk assets. To be perfectly frank with you, I'm surprised gold didn't, once it got through 1750 this morning, which didn't seem to be an issue for it. I was surprised that it's not holding the 1725 level, which I considered pretty significant support. Now, it's still early. It may close above it. I always base my technicals on close. So we'll see how this market finishes off during the day. But right now, the technicals look terrible for gold. And if we can't get over that 1725, there may be some selling into the Asian market on Sunday night. And we may see a test of 1700 early next week.
Right. Okay, so that's a very good point, Peter. It's down $48 right now as we speak. Do you think gold is down primarily because of the sell-off in risk assets? Usually when risk assets sell off, people immediately sell gold as well to raise cash. Or do you think gold is down because of the strength of the dollar? Which do you think is more likely?
Well, from a strength of a dollar perspective, the dollar is stronger than it started off at the week, but it's not materially stronger. The euro opened the week at just north of 122 to the dollar, and it's now just under 121. The yen's down about 2%. But where my focus is, when I look at the commodity pictures, my currency of choice to watch is the Canadian dollar. And at the beginning of the week, the Canadian dollar, right through yesterday morning, was trading at about 125, which was the high for the past year. And this morning it's at 127. So the Canadian dollar's lost almost 2% just in 24 hours. And so I sort of correlate where I see the metals based on the value of the Canadian dollar. As the Canadian dollar has strengthened, it tends to mirror the rise in commodity prices. And when the Canadian dollar takes a hit, you generally see some weakness in commodity prices. You've got oil down almost $1.30 today, although it's had a significant run over the past 4 or 5 days. And you're seeing selling both in gold and silver. Now, yesterday, silver held up at the 2750 level as gold broke down below 1800 on Tuesday. Silver was still holding fairly well, and so was platinum. But eventually, silver just succumbed to the pressure, and as gold broke through that 1775 level early this morning, and then through 1750, selling came into the silver market as well, and we're looking at silver right now in the low 26s.
Okay. I've been speaking to economists about the relationship between yields and gold. As you know, if yields rise, it means the opportunity cost of gold, holding gold, is also higher, which means gold should go down. I'm looking at the yields over the last year. So yields, the nominal 10-year yield has reached an all-time low last year around the summertime, July, August. That coincides with the all-time high in gold prices. And ever since then, yields have been ticking up, gold has been ticking down. I wonder then if that really is the sort of the max level of gold price, assuming, because yields were pretty much at zero, it couldn't really go much lower than that. And so would that indicate the ceiling for the gold price for you? If let's say the 10-year yield is at 0.25%, under 0.5%, and the maximum price for gold is $2,100, would that be the max price for gold?
No, I don't think you can make that correlation. Okay. I think yields of the rise in yields has been a recently new phenomenon, in the sense that it's basically just sort of been progressing over the past 4 to 6 weeks. This wasn't something that was taking that had any legs to it near the end of 2020. I think what the perception is that the economy looks like it may be getting better with the
Yes.
with the virus, and there's just some pressure on yields because of that. I think it's premature. And I don't think the Fed's going to take any action yet, but I can tell you if that Dow drops below 30 and starts to run into some serious trouble, I think the Fed steps in here.
Yeah.
So I'm having trouble understanding this drop. I can understand the concept of moving away from some risk assets and raising cash, but I think the macro picture is still very positive for the commodity index in general. And I think gold at 1720 continues to look attractive to me.
Right. So it's not just gold that's down today. Silver, palladium, platinum, it's all down. Same metrics, same forces driving those prices down as well?
Well,
Peter?
I mean, if you look at silver, it's down, but we're still sort of in right now. It's trading at around 2640. When silver got to a high of 29 when gold was at $2,200, and silver's down $3, which is approximately 10%, and gold's down $500, give or take, from the high. So I still think that there is interest in silver at these levels, and I certainly think platinum south of $1,200 is an opportunity to buy. I do not think that the trend in the industrial metals from the upside is over by a long shot.
Right. Okay, so let's talk about very quickly the equities markets. You mentioned that should the equities markets, the Dow drop even more, the Fed might step in to intervene. Why would the central bank intervene on lower equities prices, Peter?
Well, it's basically fear. I mean, every time there's an issue with the economy, the first place it shows is in the equity market, and it's just sort of a barometer that the Fed looks at. I mean, it basically is a bastion of wealth and liquidity, and if that starts getting hit and dropping significantly, I mean, there are a lot of people affected by it, not just the rich. I mean, people that that have 401ks, pension plans. I mean, it affects the economy overall, and eventually it creates fear and it scares people from spending. They get nervous, and so the Fed steps in and tries to mitigate that angst by creating some liquidity to support one of the markets that maintains a significant allocation of wealth for the American people.
Well, what could they do? The Fed funds rate is already, very low, near zero. What else could they do?
Wouldn't get the Fed funds rate, but they could do more in their bond purchases. I mean, the Fed has a number of tools out that can create liquidity for the market. They could intervene against the dollar.
Sure.
There's a number of things the central bank can do if they think that it's starting to get out of hand. And I think it's premature. I don't think it's getting out of hand yet. Again, the Fed's looking at this and saying, well, the Dow's still at 31.2.
Yeah.
That's not bad. It's not trading at 18,000.
Sure.
But again, investors, especially traders in the gold market, have been looking for a catalyst to bring this market higher, and they just haven't got it. And eventually, sometimes you just sort of get bored with it, and you're seeing other asset classes that might be doing better, and you liquidate your investment and you move into other things. I wouldn't, but I think you're seeing that type of action in the market. And you're also seeing computer selling. I mean, again, 1775-ish was around the 200-day moving average. Once we lost that, there was nothing but sort of air until 1750. Got through that relatively easy. I would have expected again, and I still hope to see gold close above 1725, that 1725 level will hold. But again, it's all technical selling, and you've got computer algorithms that are indicating the momentum is down. So it just sort of feeds on itself. From a chart perspective, if we lose 1725, I mean, I think there'll be some support psychologically at 1700, but the next main target I'd be looking at would be the 1680-85 level as significant support.
All right. Okay. Well, that's let's talk about the relationship between equities and gold now, because like you said, if the Fed intervenes on lower equities prices, that should be supportive for gold prices as well, could it not? That action from the Fed?
I mean, if the Fed does something extraordinary as opposed to what they're doing right now in support of, we'll use the equity market as an example, yes, it definitely, in my opinion, would be constructive for the gold market and for silver.
So yeah, it just occurs to me that the gold and equities markets right now are seeing a positive correlation. Is that fair to assume? Is that something you considered as a trader?
I think what happened to this market was, I think the market got caught off guard. They did not expect the 10-year to go north of 150 on the yield basis. They thought there'd be a wall there and it would back down from that. And it doesn't seem to be stopping here yet. And I think that's making people somewhat nervous about the yields and the potential short-term strength in the dollar that these yields may cause. And they look like they're trying to jump ahead of the curve, and they're selling gold in anticipation of a stronger dollar. And I think any stronger dollar, I think, will be short-lived. But again, traders trade based on what they see, and again, once they start hitting the button to sell, it tends to be a cascading effect once the momentum picks up.
Okay. You talked about the downside support levels for gold. What about the upside resistance levels? Any resistance levels you're eyeing?
Well, yeah, I mean, again, this is based on the assumption we get a close at over 1725, but if we don't, then 1725 becomes resistance. Then next significant resistance will now be the 200-day moving average, which is about at 1780. And we'll need to clear those two hurdles before anybody can talk seriously about a test of 1800 or beyond.
All right. Well, thank you very much for the update, Peter. It doesn't look like it's bright days ahead for gold investors, at least for the foreseeable future. But we'll see what happens.
I mean, if investors were looking for a pullback because they missed the move higher, they're getting their opportunity to pullback. I mean, it's all relative. It depends where you are.
Sure.
In the game, if you're long at 2190, you're obviously not very happy. But
you're right. I mean, on a 2-year basis, gold is still looking. The long-term chart for gold is still looking very strong. If you just zoom out and take a look at 2 to 5 years, we're still at a very high point.
True. Again, but if you're a trader, this market is. If you're long, I mean, you could be short and then you're happy. But if you're a trader and you're long this market, you're not feeling very good right now. Again, as an investor, the broken record scenario, it's part of your portfolio, and you make adjustments. So if it was 10% of your portfolio and now you have this downdraft, you recalibrate your portfolio, and if gold's at 8% or 5% because of this drop, then you add to the position in gold to bring it back to 10%. And that's the way you have to do it as an investor. And if the market rallies and your position is now not 10 but 14% of your portfolio, you sell 4%. And you need that discipline whether you're buying gold or Apple stock or anything else. You just recalibrate your portfolio either every 3, minimum every 6 months, and again, you keep your weighting where you want it, and you add or subtract to that weighting depending on which way the market moves.
All right, Peter. Thanks very much for your update. Let's catch up next week.
All right, then. Have a good weekend.